The biggest economic news of the week just sent shockwaves through the market. It's created a major new risk for your savings, but it's also opened up what could be a once in the month opportunity to profit. The Federal Reserve made its move. The job market is sending mixed signals, and an unstoppable technological force is rewriting the rules for economic growth. This is not the time to sit on the sidelines. The gap between the financial winners and losers is widening, and the moves you make this week could decide which side you land on for months. I'm breaking down exactly what you need to do, whether you're an investor or just trying to manage your budget. Let's get straight into your action plan. Before we get into the details, let's just get a feel for the market landscape. This past week was all about tension and uncertainty, and you could see that nervous energy in the major indices. The S&P 500 ended the week pretty much flat, just struggling for direction as investors tried to make sense of all the conflicting economic signals. The Nasdaq, which is packed with the tech and AI names we'll talk about, showed a bit more life but was still all over the place, caught between the excitement around AI and worries about the broader economy. But the bond market, that's where the real chess match was being played, with Treasury yields reacting in real time to every word from the Fed. This week wasn't about a clear bull or bear story. It was about a market grappling with a divided and complex reality. Understanding that division is the key to figuring out what comes next. The headline story that was on every financial channel this week was the Federal Reserve's decision on interest rates. As pretty much everyone expected, the Federal Open Market Committee, or FOMC, cut its policy rate by another 25 basis points. That brings the new target range down to 3.50% to 3.75%. This is the third cut in recent months, continuing a trend of easing up to support a cooling economy. On the surface, a rate cut sounds like great news, right? Lower rates are supposed to make borrowing cheaper, get people spending, and give stock prices a boost. But the devil's in the details, and the details here paint a much more complicated picture. First, the vote wasn't unanimous. The committee was split, with several members dissenting because they were worried about inflation and wanted to hold rates steady. This division is a big deal because it tells us there's no clear agreement inside the Fed itself about where to go from here. They're wrestling with the same confusing data we are. Second, in his press conference, Fed Chair Jerome Powell really hammered home the point that future policy is entirely data dependent. That's the Fed's way of saying, don't get used to this. They aren't locked into some long term cutting cycle. They're making these calls one meeting at a time. And if inflation heats up or the job market changes, they could easily hit the pause button or even reverse course. That uncertainty creates risk. Finally, we got the dot plot. This is a chart showing where each Fed member expects rates to be in the future. The latest version signaled only one more small 25 basis point cut for all of 2026. This threw a little cold water on a market that was hoping for more aggressive cuts next year. It suggests the Fed thinks its job is almost done and that rates will stay higher for longer than many investors were betting on. Your action plan. Let's turn this into some concrete steps. I'll break this down for three different people: the beginner retail investor, the advanced trader, and the everyday household. For the beginner retail investor, first, this is a moment to focus on stability and cash. Your main action here is to rebalance your portfolio and beef up your cash buffer. Rebalancing just means getting your investments back to their original targets. Over time, the stuff that does well, like stocks, takes up a bigger slice of the pie, increasing your risk. Now's the time to trim a little off those winners. Most importantly, make sure you have 3 to 6 months of living expenses tucked away in a high yield savings account or short term treasury bills. That's your defense. If this uncertainty turns into a downturn, that cash means you will be forced to sell your investments at the worst possible time. Second, for your stocks, stick with broad, low-cost index funds for the core of your portfolio, like an S&P 500 ETF. But maybe consider a small tilt, say 5 to 10%, toward quality, large cap tech, and AI related funds. This lets you get a piece of the powerful AI trend we'll cover without the huge risk of trying to pick individual stocks. Third, in your bond allocation, lean towards short to intermediate term bonds and cash. With the Fed's future path so up in the air, you don't want to be locked into long term bonds if rates suddenly move higher. Short term treasury bills are paying nice yields right now and are a great place to park your cash safely. For the advanced finance savvy viewer, for more sophisticated investors, this divided Fed creates some tactical opportunities. First, all eyes are on the yield curve, specifically the 2-year versus 10-year treasury spread. If the economy dodges a recession and the Fed keeps up with modest cuts, we could see that curve steepen. That environment could favor extending duration in your bond portfolio to lock in yields. But if the labor market data really starts to fall apart, you'll want to be defensive with short term T bills and maybe some hedges like gold. Second, this is a prime environment for sector rotation. Think about overweighting the clear winners of the current story: AI and cloud infrastructure, certain enterprise software companies, and firms tied to building data centers. At the same time, consider underweighting consumer discretionary stocks that are most vulnerable to the financial squeeze on households, which we'll get to next. Institutional money flows from weakness to strength, and right now, the strength is in the AI buildout. Finally, think about your hedging strategy. Instead of paying for expensive puts on the major indices, you could look at put spreads to define your risk and lower your cost. For single stocks that have had a huge run up, collar strategies, selling a covered call to finance buying a protected put, can be a smart way to lock in some gains while keeping some upside. For the everyday household, for households, the action plan is all about building resilience. First, you need to budget for sticky prices. Just assume that things like services and any goods hit by tariffs will stay expensive for a while. This means taking a hard look at your non essential spending. It's time to tighten the belt on subscriptions you don't use, eating out, and other nice to haves to free up cash for essentials and, most importantly, your emergency fund. There are AI powered budgeting tools that can connect to your accounts, track your spending automatically, and show you where you can cut back. Using these tools can give you the clarity you need to make some tough but necessary changes. Second, if you can, hold off on any major debt fueled purchases. If you are thinking about a new car or a big home renovation that requires a loan, now might be the time to pause and see how things look in a few months. The mix of high prices and job uncertainty makes it a risky time to take on big new payments. Now let's turn to the most powerful and exciting story in the economy today: the artificial intelligence investment boom. While other parts of the economy are cooling, corporate spending on AI related software, equipment, and especially data centers has been explosive. In the first half of 2025, AI related capital spending was a massive driver of growth, and a major reason the economy has remained more resilient than many expected. Companies like Microsoft, Google, Amazon, and Meta are projected to spend hundreds of billions on AI infrastructure. This spending has been a critical support for the economy. But this incredible boom has its own risks. The first is concentration. This growth isn't spread out evenly. It's highly concentrated in a handful of hyperscaler tech giants. The fortunes of the stock market and, to a large extent, the US economy have become heavily dependent on the spending decisions of just a few companies. Any sign that they're pulling back could have huge ripple effects. Navigating this requires more than just buying a few stocks I mentioned. It requires a framework for understanding these macro trends, managing risk, and spotting opportunities before they become obvious. It requires a real world playbook, not academic theory. Smiling? This is exactly why I created my macro investing masterclass. In the course, I distill everything I learned from my time in investment banking, corporate strategy, and building a good education company into a simple, actionable system for everyday investors. I teach you how to analyze global shifts like this one, how to build a resilient portfolio, and how to spot the asymmetric opportunities that can truly build wealth. If you're ready to take the next step, Click the link in the description to get started.